What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is November 29th of 2019. Well, folks, I hope you all are having a fantastic day wherever you are, and in today's update, we've got a wide range of news to talk about in relation to crypto markets, but we're also going to be talking about the European Central Bank, or the ECB, implementing a new system known as tiering to try to combat the mayhem in relation to negative interest rates. It's a very interesting situation. Central banks yet again meddling in monetary policy. And outside of that as well, guys, we do have a sponsored interview with Invictus Capital that I highly recommend you stick around for later on in the video. So that all being realized, let's go ahead and dive into the video, guys, and take a look here at cryptocurrency markets. As we can see, we see the vast majority of cryptocurrencies in a no trend scenario between 2 to 1% to the upside or downside at the moment. So nothing too severe going on right now. Markets have not changed too much. If you take a look here at price, though, Bitcoin has definitely been chugging along on the weekly. Our indicators have not signaled a full reversal yet. We have a slightly declining divergence here on the MACD, but outside of that, we still had a cross downward back a few weeks ago, back in September, and ever since have not gotten the cross to the upside. Along with that as well, on the stochastic R side, probably looking weaker than any of the indicators. Got into the purple channel, has now been going downward. Now both lines are looking to tick under that purple channel, again signaling that we've got some time before we actually get a trend reversal. And also, the squeeze momentum indicator still setting in lower weeks here without a higher week. So again, nothing has signaled a full trend reversal. However, on the daily time frame, we can see over the last 5 days, we have gained about $1,000 back in Bitcoin's price. Really good to see. And valuations have risen because of that in the overall market. We can see as well here on the hourly, things are looking really nice. A lot of people have pointed to the fact that this looked like a head and shoulder reversal pattern, right? We saw the head here, you got the shoulders, and then it looks like we may have the continue through or the follow through after that trend formation where we might start climbing higher. I have no doubt that that's likely to happen, and I think we'll likely see a reversal on some of our indicators over the next few weeks because, again, I don't see price going down much more after this. I think we've had a pretty stark correction. We've had pretty much peak capitulation. A lot of people are absolutely panicking and believing that Bitcoin's dead because the chart doesn't look so beautiful in the short term to some people, but in reality, we're actually pretty much on line for where we should be. We were just overextended beforehand. I can repeat it a million times. You guys probably already know that by now. So I don't want to kind of fret you guys with price action. Bitcoin dominance does not change too much. Most of our altcoins are still doing the same as they were before, and I have not changed any positions. I have not actually sadly built any positions down here because I've been putting money into my startup right now. And again, if you guys haven't already, check out the email down below or the email list. It's banking for the 21st century. It should be one of the top things. And if you guys want to keep up to date, I'll let you guys know when it drops. So one thing we've got to talk about is something that I think very few people were talking about early on, and still to this day, people are not talking about enough. And a lot of people still believe many people don't notice it yet, okay? I think people have gotten smarter and have noticed it, but it's just difficult to know about it if you're not too active in crypto. And it's the issue of fake exchange volume and fake players coming into the space. Okay, so this is breaking news today. An exchange called IDEX, not to be confused with IDEX, which is one of the decentralized exchanges in the space. IDEX is a emerging exchange that came up, I think, back maybe in the later part of 2018. Hasn't been around for that long, came out of nowhere, has now admitted that the CEO has vanished with all of the cold wallet keys. Right, so they even did cold wallet storage, but however they were managing the private keys, the one individual, the CEO, was able to obtain all of the funds and run away with it. So I want to go ahead and talk about something that I've kind of brought up before. Many of you already probably know about this. I brought up a really big issue in this space, and that is that I think, all the data aggregate sites in the space, and not to mention as well, just a lot of the authorities in the space that help provide this kind of information, has given a platform to IDEX. And I think it's a very big issue. And not just IDEX, it's dozens of different exchanges that have popped up overnight. And the reason why I have an issue with this is because people look at the fake volume they're producing. You can call it wash trading, call it what it is. It doesn't matter if they're just generating the numbers or if they're actually processing trades, whatever it is. They control the order book in that case. They're the exchange. They can make that fake volume. When they make that fake volume, it allures investors, and it also allures projects. And these are the two ways that these companies make revenue, right? These exchanges are not processing real trades. They are most likely not processing real trades, and along with that as well, they don't have real volume, but they can give a perception that they have volume. And when they do that, they go around to projects asking for listing fees to bring volume to their project. When you control the order book and you can print 2, 10, 50, $100 million in fake volume for any token and practically dictate the price if it's not on any other exchanges, well, that's a pretty good slam dunk deal. 50K, 100K, start making a lot of revenue when you get dozens of cryptocurrency projects coming to you. And this is already bad enough, right? I would feel bad for the projects who would get duped by this because they just don't know about how these exchanges are producing fake volume. But you want to know what's been my gravest concern that I don't hear people mention a lot? Is that when these exchanges pop up, another main revenue model, it's the first one I mentioned actually, it's really at the end of the day to get you to deposit your money on there, right? To deposit your crypto on there in order to go on there and trade on that very liquid market. And lo and behold, many people don't realize that the moment you make that deposit, it's not like making a deposit on Coinbase or one of the heavily regulated exchanges or the ones that have actual practical cold storage solutions where you're only taking on a little bit of risk that someone might hack it or there might be some kind of insider who might damage it to some degree. No, you're putting it on some no-name exchange who can run away with the money overnight. And that's exactly what happened with IDEX. I've been talking about this for months. There's already been about 3 or 5 exchanges that fit in this category who have had this happen to them. And now they're adding on to the many names of Quadriga CX, what we just saw the other day with Upbit. It doesn't matter if it's an exchange hack or just someone within the company. There is a huge honeypot to run away with it. And IDEX, again, is one of these primary examples. And now people can't withdraw from it because there is nothing to withdraw. They are just like the banks that have committed the bail-ins back over the last few decades. They're just as criminal. And we have completely turned a blind eye to this. We still report this volume when we take a look at the volume indicators on coin aggregate sites. I just think it's one of the biggest issues, and we haven't had enough quickness to address it. However, I'll give credit, again, sponsor of the channel, but one thing I do like about CoinMarketCap is they've actually tried to work towards fixing this to some degree, and they've been doing it through their liquidity tool. Right, so you can see if you actually look for the underlying liquidity these exchanges hold, right, and I don't think they have all the numbers just yet, but you can see here that IDEX only has about 2.5 million in crypto. So good news is this isn't $50 million or billions of dollars. The issue is that's still $2.5 million, right? So why are we going to give a platform to someone who's recording $750 million in volume, right? And you look across all the coin aggregate sites, Coin Paprika, all of the different players and stuff like this, and even some websites outside of the major coin websites. Why are we even giving someone a platform who is recording that they have more volume, nearly as much volume as Binance, more than Huobi, and more than OKX, and more than Bitfinex, when they only have $2.5 million worth of crypto? People are losing money because of this, and it's very scary to see this. I feel so bad, and it's just... It makes me upset because this is such low-hanging fruit that we could fix. This shouldn't be happening. People should not be losing this kind of money. A CEO shouldn't be able to walk away overnight. There needs to be checks and balances. We need to understand what kind of cold storage solutions these companies are using. We should set a high bar here and say, look, you might want to get listed on our site, or you might want to get your exposure to the broader community. But until you prove how you do that, how you commit your storage in this case of user funds, until you show you have checks and balances in place, industry standards that we see on some of the top exchanges that have been here for nearly a decade, we're not giving you any coverage. Don't think you can just walk into this game. We have to protect users. That's the responsibility we should be seeing across all cryptocurrency websites. Just a big point that I want to make. It's something that really comes from the heart here in this case, guys. I hate to see people losing funds because I know there's not going to be any insurance fund for this. There's not. Sorry. I mean, maybe I'm wrong on that. I can't speak on 100% certainty, but I don't think people are getting their money back. We've already seen some of the better exchanges in this case not do it. So, anyways, one more sadly negative piece of news on crypto. So there's a lot of these headlines across the cryptocurrency space. I'm not just hitting on Ethereum World News, but people who turn headlines and for silly traders who make ridiculous calls like $220 XRP or now going to 3 cents XRP. I wouldn't say it's crazy. If XRP failed as a project, it'd go down here. But just the sheer range of price calls and the emotion of some of these top tier traders on TradingView and crypto Twitter. I just want to go ahead and use this as an example case, and I'll get to my point very quickly. So this is Magic Poop Cannon. Guys, okay, like if the name already enough was not enough to just throw you off, he has been vehement, as many people have on crypto Twitter and TradingView, about the absolute parabolic $220 rally or whatever multi-$100 rally that XRP was going to go to, because we were getting close to lining up with a trend line that we've seen in the past. Okay, there's no way you could actually build a solid bottom support here, right? I mean, unless if you want to maybe keep it exactly aligned here with the previous one, okay, but that's not always how channels work, right? People were so confident that this was going to just do another parabolic rally, and we've talked about this, that the chances that XRP could move to some degree or possibly get some buyers there, but we never claimed $220. That's ridiculous. And now this same person, just because it's going slightly below this channel that they believe is the almighty support line, is now calling for, oh no, you know, we're going to crash to 3 cents. That's such a misinterpretation of using the logarithmic chart, of using channels, of just interpreting cryptocurrencies. And no trader, I think, worth their salt will ever make a call going from $220 to, oh, now it's going to 3 cents. It was one of my favorite cryptocurrencies. Now it's going to 3 cents. Really? And people follow this. He's one of the top traders on TradingView. I can't believe it, guys. This is just a good summary here. XRP will change the world. I liquidated all my crypto holdings until I start to see some improvement. Oh man, I don't know who it is, because they're hiding behind an anonymous figure. Nothing wrong with that, I guess, but I definitely wouldn't choose my handle to be Magic Poop Cannon. Then again, people followed him, so I don't know. Anyways, let's go ahead and talk about something with some actual substance, guys. The first thing I want to talk about here is we're going to take a look at the daily shop brief, and then we'll go ahead and dive into the ECB in just a moment. There's really two data statistics. In the United States, a sign of slowing employment. Slowing employment. I was saying unemployment. Well, it may be unemployment soon enough, sadly. But the growth in small business employment has been slowing. So we can see here that ever since back here in 2011, we have seen a slowing growth, right? It's not a decline yet, but a slowing rate of growth for employing individuals across the board. So here we're getting very close to 0%. And I can see this, we've kind of gotten a sense of stagnation around us when it comes to hiring at new small businesses. And to be fair as well, this is an even worse sign, because even though we had previously high levels of growth, this is in relatively low paying scenarios, and usually part-time or areas where people are working possibly a second job in this case, right? So key thing to keep in mind. Another thing to talk about as well is what we're going to really be focusing on, and that is the negative yielding debt crisis and negative yields within Europe. Now, we can see here, interestingly enough, as we were watching the negative yielding bonds back here in a good part of 2019, we've now actually seen a pretty stark decline here, all the way from 17 to nearly $12 trillion, right? So we've gone down about $4 to $5 trillion. You can kind of you have to get the specifics here, the numbers, but around $4 to $5 trillion less than where we were. So we've actually been able to see the ECB in the short term stop the trend. They've been able to put a shock response here with a new thing they call tiering. We're going to talk about that in just a moment to actually reduce some of this worry and negative yielding bonds. So what is tiering in this case? So, have people used it before? What does it entail? Well, to answer some of those questions, I'll go ahead and give a very brief explanation of tiering. So tiering is a strategy that the ECB is utilizing, that Switzerland, as well as Japan, who have experienced negative rates for some time, have utilized. And it's a way to reduce the burden of negative yields for banks. So one thing to talk about to those of you out there, who might understand, might be curious, why is it that a bank is struggling in a negative yielding environment, right? Why is it that, especially, in this case, as rates go down, it's usually a beneficial thing for banks? Well, for commercial banks who are not lending out cash on the books, right? If they are just holding their cash, right? In that case, it is negative for them because they have to pay a penalty. They basically pay to store their money, right? So they are basically losing money every time they're not utilizing their capital. So it shows two things. It showcases that negative yields can be a burden, negative interest rates in this case can be a burden. But along with that, it shows that they are that worrisome about lending their money out to the market when they're literally willing to pay a penalty in this case to holding their money. That shows you that the ECB is in a very interesting situation, whether it be people are not creditworthy, whether it be that the economy in the eyes of these commercial banks is stagnating, not worth the risk of lending out capital, where they're more likely to have more defaults than the rates that they're charging, right? That just means basically there's not a good market fit for them to actually utilize this money. So we talked about that. What is tiering in this case? Well, tiering is where the ECB, much like other central banks, has decided to remove charging negative interest rates on capital over certain reserve requirements, okay? So each bank across the world in different geographical regions, each commercial bank has reserve ratio requirements. They need to have a certain amount of reserves inside the vault, right? Well, in the case of the ECB, if you have over 6 times the reserve requirements, you can actually avoid any capital above that 6 times reserve requirement will actually not face any penalties, right? It actually won't face a negative interest rate, just won't have any yield at all or any interest rate whatsoever, positive or negative. So that's the interesting thing to talk about here, is that the ECB is now attempting to copy this model that Switzerland and Japan have implemented and supposedly has led to a little bit of success. But we'll have to see as time will tell whether or not this will be beneficial for the ECB, right? Now, again, to keep in mind here, it is a tiering system, right? So it's kind of broken into tranches to make that simple and not overcomplicated. The money under that 6 times reserve requirement is going to still face the negative yields. So who is this going to benefit in this case, right? Because not all banks are the same, and not all banks have the same incentives. This is one thing I always try to preach to people. It's not just one group or cabal of people, who are meeting at the end of the day at the ECB or at, at these commercial banks. They have misaligned interests against one another sometimes. And I'll give you a good example of this. In this case of keeping in mind the idea of tiering, small Italian banks that are not making a lot of money, that are not lending out a lot, that don't have much reserves, are hating this because for them, they're still facing the same penalties of negative yielding, negative interest rates in this case. Sorry, I keep mixing the terms of negative interest rates. But a large commercial lender like Deutsche Bank, that's at the heart of Germany's lending economy, well, they're loving it because they're going to save hundreds of millions of dollars according to JP Morgan, right? I'll go ahead and see if I can find the quotes for you guys. I recommend you just read through the article here. It's a really good article that just kind of summarizes all of the major things. But JP Morgan and Chase is estimating that this measure will save Germany's biggest lender roughly 200 million euros alone this year. Millions of dollars. So there's a big difference here between some of the smaller Italian banks, as they mentioned, or Southern European other lenders within Southern European nations, right? There are different banks in different positions that benefit from this policy. And what it's going to lead to, one of the negative impacts, is that it's going to further consolidate the banking sector because for these larger banks, they have now become more profitable, right? And it's further continuing to allow the squeeze on these smaller banks that are likely, if you're talking about Italian banks, already in bad positions, right? So again, you're going to see more consolidation of the banking sector. That's one negative thing. But there's another as well that many people aren't considering, right? One thing that it could result out of this in the sense of, actually, let's see if I can get the right proper area here within the article. Let me see. Oh, yes. With other ECB measures, right? So we were talking about repo markets a while back, right? And one of the biggest concerns here is that in the overnight lending or interbank lending market, where banks are basically lending money to one another, right? This happens within Europe. It happens in the repo market in the United States. The issue that could arise here is that because of these different penalties on certain amounts of reserves, it could lead to people setting an over an amount of demand on the interbank market. And this could lead to rates spiking, in this case, for the interbank market. So there can be unintended consequences from these central bank policies. So it's very important to keep all that in mind. And again, I won't dive into all of it today, guys. The article is a bit lengthy and stuff, but I recommend you go through this, look through some of these key points, and just consider it's going to be very interesting. This is going to save European banks about 7.5 billion euros annually, the equivalent of $8.25 billion. And that's a lot for the European banking sector, right? So do you guys think this is good? Do you think that, I think most of us would probably agree that central bank meddling in general is not a requirement for sound money and a sound economy. But at the end of the day, this is where the ECB is going. They're barely struggling to get by on negative rates that they've dug themselves into, and they're having to find ways to make it profitable. But it seems the only way they're going to do it is by giving themselves a pat on the back, giving themselves a way out, and squeezing the little guys who don't have a way to speak up. Shows you how ruthless bankers can be. Anyways, I hope you are having a fantastic day wherever you are. Let's go ahead and jump into this interview with Invictus Capital. Alrighty, everyone. So in today's sponsored interview, we're sitting down with Matthew Finlayson, who is not only one of the 4 co-founders of Invictus Capital, but is also the head of product. And we're going to be spending some time to talk a little bit about how Invictus Capital is aiming to truly streamline the new production of investment vehicles in the cryptocurrency space, as well as other financial markets. So it's a very interesting topic to me. It's very close to heart. But Matthew, thank you for making the time, man, all the way from South Africa. I'm here on the East Coast. So we'll make the best of this conversation. I appreciate you making the time.
Yeah, thanks, Jeff. It's great to be here.
Awesome, man. So let's go ahead and actually talk a little bit about, what you guys not only do right now, but a little bit about how you guys have kind of pivoted the idea of what Invictus was from the get-go. I think it's an interesting story from the times that we've talked so far.
Yeah, so, we started all the way back in 2017 with Crypto 20, which at the time was the world's first tokenized crypto-only index fund. And basically, the 4 or 5 of us got together. Generally, all of us were from an engineering background or had done kind of science or computer science type of work previously, and we kind of realized that there was this huge opportunity in the crypto asset investment space, where new entrants into the market, basically didn't have an option. Everything was very complicated. You could basically only buy like either just Bitcoin or ETH, or people were investing in all sorts of ICO projects. So we came out with the idea of an index fund and took very much a data science approach to creating the fund. So our fund, for example, is capped at 10% per asset, rebalanced on a weekly basis as the top 20 assets. And we launched that to great success and, immediately had a community around us. And for that, we raised around $40 million or so towards the end of 2017. So off the back of that success, we then started Invictus Capital, which would then be the kind of the umbrella company underneath which we could launch more funds. And in doing so, we've launched additional tokenized index funds, and we've launched a venture capital fund as well. So now we have 5 funds in total, and we kind of realized in launching funds and, coming at fund management or asset management in general from an engineering perspective, we'd really redone the process of asset management from the ground up for our own purposes. So it really made sense then to see ourselves as an asset management platform upon which we've launched our first few funds to prove our technology. Now, the most recent fund we've launched is actually a third-party fund where we're not the fund managers for that. We just handle the distribution and client onboarding and all of that, right? And it's very interesting if you compare it to how traditional asset management works. A key feature we have in our advantage is that we use blockchain technology to run our asset management platform. And this allows us to basically have zero cost investor onboarding and, zero cost maintaining an investor relationship. So where previously, every single asset manager had high minimums to invest, or there were long lockup periods, or for VC funds, for example, you basically just can't gain access unless you have a few $1 million and you're willing to wait 7 years. Through tokenization and the use of our platform, we really democratize access to these kind of financial products to investors around the world who are now able to gain access to products they would otherwise not be able to. Sorry, go ahead then.
No. So basically, you guys are really doing two major things here. You're not only making a platform where we can build out more financial products and I guess gain more exposure to different financial spaces, but outside of that, you're really lowering the barrier here for a whole range of individuals across the world to get access to these markets, and that's obviously using blockchain technology. So that's exciting.
Absolutely. So we're very interested in the emerging market, and I think it's often a very underlooked space, especially when it comes to asset management. But fundamentally, a lot of people in emerging markets don't have access to good financial products or don't have access to dollar-based investments. And in large part, it's because the traditional way that things are done is not able to service them because it's too high friction and too high cost. Whereas in our case, for example, we've got thousands of investors in multiple different emerging market countries, and that's exclusively because we offer products that you can invest in with, say, $5, and it's globally accessible, kind of on demand. So it's a completely different user experience from what traditional fund managers would be able to offer with their kind of asset management and distribution platforms.
Yeah, it's been really for the last few decades that unless, you're usually an accredited individual, most hedge funds either, well, I know at least in the States you can't interact with hedge funds, but for the broader market, in this case, for the global economy, it just hasn't been where these providers have even considered, I guess, some of the lower end retail investors.
Yeah, and there's like a constant theme of financial inclusion that's spoken about quite a lot throughout the crypto space. And it really is empowered through the use of blockchain technology, which is fundamentally different from just, say, Bitcoin, for example. And like, it's really a paradigm shift in the way that people can gain access to financial products that serve them, because now these barriers to entry that existed for legacy reasons are basically overcome through technology. And I'm very excited to see where that will go over the next 5 to 10 years, as more and more people kind of catch on to the idea that these previous limits that existed with respect to both emerging and developed market investors, really shouldn't exist anymore.
Absolutely, Matthew. I completely agree with you. I think it does speak to the ethos of blockchain and crypto overall, of being able to actually include the other 1.7 billion people who don't have access to banking services, but even the broader audience of people who may have access to banking, but don't have access to true financial freedom, true financial services to let their capital grow, or at least hedge their wealth to some degree. So I'm curious as well to kind of go deeper on this topic, Matthew. For where you guys are at right now, where are you seeing most of the demand for your product in this case? And what are some of the markets that have gotten people interested in using your product?
Okay. So we definitely focus pretty specifically on alternative investment products at this point in time. So, alternative investments are things that aren't like mainstream stocks and bonds, for example. So we've got crypto funds, which I'll speak a bit more about. And one of the most popular recent funds we've launched is the Invictus Margin Lending Fund. And the margin lending space, or the lending space within crypto, has really blown up over the past 6 months to past year, where you're seeing a lot of peer-to-peer lending happen, and these kind of markets were generally reserved exclusively for institutions again. So this fund we've launched, it's got a huge amount of attention, and the returns in it to date have been really good, where we've got in excess of 10% per annum returns on a dollar-based fund. Basically, we pool the assets contributed by investors, and then we'll margin lend those out on exchange to other people taking the loans to do whatever they want with. Generally, it's for trading purposes. And the interest rates you earn on that are particularly high, and they're driven by the underlying volatility of crypto. So for this particular fund, you have no exposure to crypto itself, but your returns are driven by crypto volatility, which is very exciting because that gives a very uncorrelated return profile to any other kind of investment class. And the returns themselves are very, enticing, I guess, for investors, because the opportunity in this space, it's so new, the opportunity is very high. So I'd say the majority of the demand's been there recently. Prior to that, we saw most demand into our crypto index fund products, and that's still, very consistently there, but it's definitely waned in favor of margin lending because the space is so new and exciting, I guess. And we think our crypto products are differentiate themselves in the fact that they're generally quite low cost compared to our competitors. And again, we take a very much like a data science engineering approach to fund construction. So we prove kind of statistically that our funds are more likely to perform better over the long term than whatever benchmark we compare them against.
Matthew, I think it's fascinating that you guys have been kind of aiming to simplify and democratize the ability to gain some form of income from the lending space in crypto, because what you're basically doing is you're giving the opportunity for people to streamline access to these new projects in the crypto space that are basically allowing people to get access to a market that the bank would usually be the only one who could get access to. So, in the old world, it was basically where the banks would take creditors' money, pay them little to no interest for it, and then they go lend it out to margin traders in these emerging, tech sectors or financial markets. And now you can get these massive spreads, these massive rates on your money in this case, and you're getting direct access to it, to the financial product you guys have launched. So I think that's really exciting.
Yeah, and the same is applied for just access to a VC fund or a hedge fund, for example. Generally, when people talk about financial inclusion, they don't talk about people in developed markets, but it's absolutely the case that the majority of financial products, well, not the majority, but a lot of very interesting financial products, especially alternative investments, are reserved for the 0.1% most wealthy people within any given society. And that just is unfair. It shouldn't be the case that an investor with $100 isn't able to decide or, for themselves what they want to subscribe into.
Absolutely. I think people underestimate just how much being able to provide these opportunities through a lifetime and actually have somewhere to grow your capital, how much that would mean for someone who has $10,000 versus someone who has 100,000 or a million. Like, it means so much in order to give that kind of opportunity to everyone in that case. So, Matthew, going forward, what are some of the interesting features that you guys have coming up for the Invictus platform? Obviously, you obviously have this vision of scaling it out where people can build financial products. And you mentioned you guys had the first one that actually was out of your wing. It was someone else, a different fund in this case, creating the product. So what are the things you're looking forward to?
So I think we're really looking forward to expanding the products we have on offering. We want to offer a curated, fund selection for our investor community. And we really value the input that our community has had to date. We've got 15,000 active investors, and our Discord community, for example, has got an excess of 10,000 people chatting to us basically every day. So serving the needs that we've identified they have and providing products that we think they would find interesting is something that I think will kind of be in our own benefit and really grow and accumulate what we've done thus far. In addition to that, I think I'm very excited to see what other use cases blockchain tech has within finance in general, right? And I think it's a no-brainer for me that eventually the application of blockchain will be ubiquitous within finance. We've yet to see to what extent that will be the case, and we're kind of hoping to pioneer the application of it to asset management specifically. And it's kind of cool to see over this past year or so, when the crypto markets have been somewhat consolidating, people have still carried on developing, and the amount of activity in people coding on Ethereum or developing on EOS or whatever it may be has only increased, and it's not been something that's died along with the hype of crypto itself. So there are a lot of really fundamental issues around custody and user experience that are being solved on a daily basis. And I think things like that are only going to get better and better as time goes on. So very excited to see that happening. If we already have a platform, for example, that I would say is better than what traditional asset management can provide this early in the game, who knows what will happen 10 years from now.
Yeah, man, I think it's exciting what's been going on in the DeFi movement, just what's been going on in general, I think, over 2019, whereas a lot of people have seen it as kind of a boring year because the market hasn't really kind of taken off. I think we have to look at the broader applications that are being built, and it's been very fascinating.
And people are delivering as well, right?
Mm-hmm. It is, yeah. We're actually seeing some form of actual utility and delivery in the space where I think, the dreams that were kind of sold in 2017 are now actually being partially built. So I think we're actually having a much more a turn towards a much more realistic view of what this technology is useful for, and it's finance, as you said. It's financial markets and democratization.
Completely agree.
Yeah, so I'm very excited to see where this space is going to go over the next year. But Matthew, in this case, there's another important question that I have that I always ask about these applications, and that is fiat on-ramping. How do people actually get money onto the Invictus platform? You guys not only connect to traditional outlets, I'm assuming, but also allow people to use things like stable coins and other crypto options. Is that correct?
Sure. So you can invest in our funds directly with crypto if you happen to hold crypto already, or a stable coin. So Trust Token, for example, we accept that. In addition, through Trust Token, you can actually just do a wire transfer, which is kind of a one-step investment into our funds. So you just wire the dollars to Trust Token, and on the back end, they will transfer the dollar equivalent to us, and you get allocated your investment like that. We're also working very closely with MoonPay at the moment, which will be a credit card provider going forward. And I know they've been very popular recently. So, at the moment, we've got Trust Token, wire transfer. That's a pretty easy on-ramp if you've only got dollars. MoonPay will make it even easier going forward. And it's kind of important to highlight that, our entire platform is natively digital. We don't have manual processes. So it's very easy for us to plug into other natively digital platforms, when they launch or when they become more comfortable with crypto. One good example would be the likes of any kind of e-money provider or a mobile wallet. You'd be able to link our platform in future, and it's just a one-click investment into our products. And we're looking to do that in the emerging markets as we move forward.
That's incredible, man. I mean, just I think even a bigger issue in this case is you can even democratize that opportunity, but if you can't make interacting with the application simple to where it literally just takes a matter of a few clicks, I think that's still the biggest kind of, even here in the United States, like where there's a lot of investment in fintech applications. If you take a look at like Robinhood and some of the successful names, they only have 3 to 5 million downloads. Like it's a very minimal amount of the market share that we need to get this technology out to. So I'm very excited to see how you guys can expand there. Are you guys keeping like more of a mobile focus as well long term? Technology out too.
Yeah, it's very interesting.
Excited to see how you guys can expand there. Are you guys keeping like more of a mobile focus as well long term?
So at the moment we're exclusively on the web. So we have an Invictus website and portal, but we're aiming to develop out a mobile first approach. Over the next year would be our goal as we're expanding into the emerging markets.
I think what's even more exciting, Matthew, is just how many markets you guys can democratize. Emerging tech sectors. I think one of the biggest things that we don't think about in the States is that we get to invest in a lot of the really cool companies here in the States that are, building in emerging markets and things of that sort that might be public companies. But to give someone in a developing region of the world or someone just outside the U.S. who's restricted from that ability to invest in those companies, the ability in that case to actually get some exposure is very exciting.
Yeah, absolutely, right. So we just started with crypto funds, but the platform in no way is limited to exclusively crypto offerings, right? So our most recent fund, for example, is an emerging market solar fund that invests in solar infrastructure, in emerging markets. So you can get returns based on a long-term lease to set up a solar panel project, in a school or in a business district. And like that kind of democratized access to financing projects like that is previously impossible, basically. The nearest we've come to it is kind of crowdfunding platforms, but generally they charge 15% fees as well as upfront fees, and you don't really have access to an investment vehicle at the end of that. It's kind of a one-off, semi-donation.
Yeah, no, I'm interested to see if we get kind of away from things like crowdfunding and much more towards some of these models where you can have very, very much guaranteed equity, real dividends of some sort, actually earning consistent income. But you could also still play a role in some really interesting emerging technologies and projects. Matthew, I'm excited to see where this goes over the next few years. I want to keep up with you guys as time progresses. What are some of the ways that people can get engaged with Invictus in this case? I know you mentioned you have a great Telegram, and how can people get engaged with the actual platform? Is the sign up pretty easy?
Sure. So the sign up's pretty easy. I mean, if you go to invictuscapital.com, you'll be able to see all our products, learn about us, see my face on the team page, etc. You can join our Discord and Telegram from there. And then to sign up, you basically click the login button on the top right and go through our account registration process. And that's pretty much it. Once you're in, then you're able to send your contribution, and that's how you gain access to the fund. So, we really are trying to simplify the user experience as much as possible. So not only is it accessible geographically or accessible in terms of, who's able to get access to what financial products, we also want to be accessible from a, usability perspective.
That's awesome, man. I'm excited to see how you guys continue to grow and stuff. And for those of you who may be interested in learning a little bit more about what Matthew and the rest of the team is doing at Invictus Capital, to test it out for yourself, we'll leave a link down below in the description. Again, I've been following Invictus for a while. Matthew and I first chatted a while back, and man, it's just amazing to see how far you guys have come. I'm really excited to see these like stepping stones that you're really making for the company. And I think it's towards, again, not only the ethos of blockchain, but it's going to do so much for being able to actually bring these wealth opportunities to everyday people. So I'm completely on board with it, man. And it's been a pleasure to talk with you, Matthew. Thank you for making the time, man.
Thank you. Thanks so much.